Yesterday, the Reserve Bank of Australia announced some pretty significant stimulus measures for us here in Australia. And if you're too caught up in the excitement of the Melbourne Cup, then stick around for this video because I'm going to run you through exactly what went down and how it applies to you. Hello guys, Brad here from The Guided Investor. Welcome back to the channel for another video. If you're new here, consider hitting that subscribe button because I post regular videos about how you can do more with your money. Yesterday, the RBA announced that they are bringing the official cash rate down from an already record low of 0.25% to a new record low of 0.1%. Now, this really comes as no surprise and it was largely anticipated. But what they also announced is that they're going to enter into a bond buying program. So the RBA wants to buy $100 billion worth of Australian government bonds over the next 6 months. So what does this all mean and why has the RBA done this? Well, let me explain. It's really all about keeping interest rates lower for longer. Now, most people understand that the RBA uses monetary policy to adjust the cash rate, and a lower cash rate entices people to borrow more money. When people borrow, it stimulates the economy, as borrowing essentially creates new money. Of the money that the bank lends out to people, it only keeps a small portion on reserve, and everything else is brand new money. With new money created, there's more cash flowing around the economy, and really this should create new jobs and help people to prosper financially. But the problem with the monetary policy is that the RBA has just about exhausted its interest rate lever. The drop in interest rates from 0.25% to 0.1% really isn't that material, and we don't even know if the banks are going to pass it on yet. So if you weren't willing to borrow money last month at an already historically low level, you probably haven't changed your mind moving forward given the recent rate cut. So this is where the bond buying comes in. The second tool that the RBA has in its toolbox is quantitative easing. And this really is another form of money printing. The RBA is going to create money in order to buy back government bonds on the secondary market. Bonds are essentially another form of debt. The government creates these bonds in order to sell to investors to raise money for spending. Now, in return, the investors are going to get coupon payments, which is basically like interest repayments for the use of their capital. By buying government bonds, the RBA wants to lower the running yield on bonds with a maturity date of between 5 and 10 years. And the reason this works is because there is an inverse relationship between the price of the bond and the running yield of that bond. And to understand this properly, let's have a look at the following equation. By buying bonds, the RBA is bidding up the price of the bond on the secondary market. As the annual coupon is set, the more the price rises, the lower the running yield becomes. But the question is why? Why does the RBA want to lower the running yield on bonds? And there's really two aspects to it. First of all, they want to make the cost of borrowing cheaper for governments. So essentially, if they lower the running yield, it means that the governments can issue more future bonds at a lower rate. So their cost of borrowing comes down, which entices them to spend a little bit more on projects such as infrastructure. And the second reason is because they want to place downward pressure on the Australian dollar. If you watch my previous video on hedging, you'll understand that interest rates are one of the drivers behind currency movements. Because when interest rates are high, it entices foreign investment into Australia because foreign buyers want to come over, put their money in Australia where they can generate a higher return on their capital than they could in their own country. But in order to invest in Australia, they need to buy Australian dollars. And in turn, this pushes up the price of Aussie dollars. By lowering interest rates, the RBA is hoping to deter some of that foreign investment in Australia. When there's less foreign investment, there's less demand for our currency and the Australian dollar will fall. But again, we come back to the question, why? Why does the RBA want the Aussie dollar to fall? After all, when the Aussie dollar is high, it means that we can buy foreign goods a lot cheaper. And back in the good old days when we could travel overseas, it was also cheaper to do that. But the RBA isn't so concerned about the Australian consumer, it's more concerned about the Australian producer. A lower Aussie dollar is much better for our exporters because it means that the cost of goods to foreign buyers is cheaper. So as a result, the idea is that foreign buyers buy more of our products, which means more money coming into Australia, which is good for our economy, at least in theory anyway. But what does all of this mean for you, the average person? Well, we're in this environment with interest rates lower for longer. And essentially that's really good for accumulators, but not so good for retirees. As an accumulator, the interest rate on your mortgage will hopefully drop, provided that the banks pass on the rate cut. It also gives you the opportunity to leverage further into more long-term growth assets, which can really accelerate the wealth creation process, provided it's done responsibly. As a retiree, unfortunately, your term deposits and your bonds are gonna produce, yet again, less return. Now, what this really means is that if you want to generate the same return on your capital, you're going to have to take more risk in your portfolio. And by pushing more and more people into riskier assets like shares, we're likely going to see a rise in share prices. So if you haven't reviewed your investment strategy for a while, now is probably a good time to do it. But that's it for me today, guys. I hope you liked this update. If you did, please give this video a thumbs up and I will see you guys in the next one.